Hello friends, welcome to Learn Easy. We will discuss money multiplier. Money multiplier can be stated as the phenomenon in which the creation of money is done in the form of credit creation in the economy. Money multiplier is a process by which banks can make more money using the money people put in. When we give our money to the bank do not keep all of it. They keep a small part safe and lend the rest to someone else. That person might spend it or put it in another bank, and the same thing happens again. So, from our one deposit, more money gets added to the system. That is called the money multiplier. So, money multiplier is equal to 1 divided by LRR, legal reserve ratio. The smaller the LRR, the more money banks can create. LRR stands for legal reserve ratio, which is just a small part of our money the bank must keep safe and not lend out. There are mainly two types of legal reserve ratio, LRR. They are cash reserve ratio, CRR. CRR is the minimum percentage of a commercial bank's total deposit which they are required to keep with the central bank or the RBI. As for example, if the CRR is 4% and someone deposits rupees 1000, the bank must keep rupees 40 with the RBI and can use the rest to give loans. Statutory liquid ratio, SLR. This is the percentage of money that banks must keep with themselves, but in the form of cash, gold, or government bonds. As for example, if SLR is 18%, then from rupees 1000, the bank has to keep rupees 180 in liquid form like cash or bonds before lending out anything. The smaller the LRR, the bigger the multiplier. That is because bank get to lend more and that keeps the money cycle going. If the LRR is higher, banks lend less and the multiplier becomes smaller. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. The money multiplier refers to the increase in money supply in the banking system resulting from each rupee of reserves injected. Commercial banks are required to hold a percentage of deposits as reserves known as the reserve ratio. Let us solve a problem. Calculate the total deposits created if initial deposits is of rupees 2000 crore and LRR is 11.5%. Solution. Given LRR is equal to 11.5% is equal to 0.115. Money multiplier is equal to 1 by 0.115 is equal to 8.69. Initial deposits is equal to rupees 2000 crore. Total deposits is equal to initial deposits into money multiplier is equal to 2000 into 8.69 is equal to rupees 17,380 crores. Why is money multiplier important? The reasons for money multiplier to be important are: first, monetary policy. It helps central bank to control inflation and liquidity through CRR and SLR changes. Second, credit creation. It shows how banks create money by lending. Third, economic growth. A higher multiplier can fuel demand and production, causing economic growth. Fourth, inflation control. A smaller multiplier can restrict excess money and curb inflation. Let us conclude here. The money generated by the banking system with each rupee of reserves injected depends on the reserve ratio. The higher the reserve ratio, the lower the potential for lending and the lower the money multiplier. Conversely, a lower reserve ratio leads to a higher money multiplier. Thank you for watching the video.